we have Mayuresh Joshi joining in from Angel Broking. Mayuresh, at Angel Broking, what kind of view are you really making on the market right now? Are you as bearish as the rest of the strategists in the market? And what are you advising your clients to do right now?
Afternoon, Ajay. I think if you see the precedent events that have happened over the last 2 to 3 weeks, I think including the IIP data at our end, which is obviously a dampener at negative 2.2%, which is clearly indicating the fact that the corporate pricing power is out. Again, I think if you look at the WPI numbers at 5.79%, it is a clear indication of supply side constraints basically seeping into the CPI, and that is the whole issue on the macro dynamics of why the inflation figures are not coming up. Obviously, fuel and power constitute a part of it, but again, I think the macro dynamics are clearly suggesting a growth slowdown in the country as far as the domestic factors are concerned. On the international side of things, I think the markets are reading into the US data with the fact that the tapering might start off and the quantum of tapering might be much higher than what was expected in the September policy. So a combination of these effects and the currency again is not helping. I think the FIs have already withdrawn huge amounts over the last 2 to 3 weeks. I think if the tapering actually starts off, I think the whole flight of safety to the dollar is something that the markets are very skeptical about. So again, I think in our opinion, I think market should stay in a very tight range between here and the September policy, maybe 5,300, 5,350 on the downside for the Nifty, 5,750, 5,800 on the higher end of the band. But then again, I think between these specific band movements, I think you might have stock movements and stock specific action that can be initiated on the index itself.
Mayuresh, afternoon. I think what's also unnerving the markets is that some of the sectors which were holding up, like IT, FMCG, those are also beginning to lose their sheen. It's a little difficult to play it at this time, but would you be deriving any comfort from the IT basket or FMCG in the long term?
I think, Aman, if you look at both these sectors, I think the valuations, yes, are a little bit of a concern across the segments. I think they are trading at the higher end of their valuation bands when it comes both to the IT and the FMCG pack. Again, something to see is individually, I think, on the sectors itself, on the kind of discretionary spends that you might see on the IT side, where a lot of your managements on your top tier companies have given a very robust pipeline happening, strong management commentary, basically indicating good utilization levels, and the currency movement basically offsetting any of the risks involved with low utilization or the kind of cross-currency impact that one might possibly see. So in that sense, I think though the headwind persists in terms of the immigration bill, I think the sector structurally over a longer period of time does look better placed within the entire pack in the Nifty basket. Again, I think FMCG typically, I think, moves on the valuation parameters again. I think the top rung companies again are valued at higher end of valuation bands itself. So again, it really depends if the monsoon is good, which one is expecting in the country. I think the discretionary demand should come back, but with high inflation eating into possibly the disposable income of the rural population and the semi-urban population, I think you might have some amount of your gross margin expansion for most of these FMCG companies not being maintained. Again, the ad spend ratio for most of these FMCG companies would more or less increase or say status quo over the next 2 to 3 quarters as they push through for volume growth going forward. So in that sense, I think one needs to cherry pick within these sectors itself, and then I think one can take a view constructively over the next 2 to 3 years.
Mayuresh, we've been talking since morning, of course, because of the massive cut coming in the banking index, that how a lot of fundamental based selling is actually happening. A lot of institutions continue to be sellers as far as large cap banks are concerned. Have you started looking at some of the numbers that if the yields remain where they are and rupee continues to remain on the weaker side, limiting RBI's measures of rolling them back, the measures which were recently taken, how bad could the numbers be, and how much further fall on the base, purely from the fundamental side could some of these large banks see from these levels?
I think, Ajay, if you deconstruct the banking area, I think between the private and the public side, obviously the public sector banks are trading at very, very attractive valuations. I think their price to book has almost become half of what they were trading at maybe a couple of months back. But then again, I think one really needs to understand that with the kind of currency movement that we've got and the potential global risk on the risk of that is continuing into the market, if the dollar flows start happening, outflows start happening, I think what you're basically seeing is the liquidity measures imposed by RBI would continue, which would impose further stress on the balance sheet and the asset quality of most of these banks on the public sector side. Having said that, I think even on the private sector side, the larger ones like the Axis Bank and a few of the banks like a Yes or an IndusInd, which are exposed to wholesale borrowings, I think they will be exposed to the RBI measures, and to that extent, I think the NIM compression might happen. So I think you're talking on asset quality over the public sector side, you're talking about more or less some kind of quality pressures which we've seen across results for the banking pack overall, where you've seen marginal uptick on the private sector side in the gross NPAs and the net NPAs, and obviously the public side shown the asset quality was dismal. So in that sense, even though valuations look attractive on the public side, I think we would still give it a miss. I think we still assume that the financial services sector, I think more or less on the banking side, would underperform large part of the market over the next 1 to 2 quarters.
And remember, these were once darlings and a must-own in every person's portfolio. But now with all stretch valuations and the asset quality concerns increasing, people are staying away from this sector as well. What about autos then, Mayuresh? Because in an otherwise declining market, something like a Tata Motors is holding up. Is there any strength that you're seeing here or any other auto stocks that you'd favor?
I think the auto sector, again, I think one needs to divide between the four-wheeler and the two-wheeler pack. Obviously, the four-wheeler pack, Tata Motors has shown a good JLR show, if I put it that way, because the JLR margins were much better than what the markets were expecting. So if you adjust for the depreciation, the amortization, and the higher tax that has happened, I think Tata Motors numbers were much better than what the street was expecting, and that was obviously reflected in the price movement of the stock. So I think the whole model is basically based on how JLR basically does, assuming that the domestic situation on the MHCV side of the business is not going to do great guns over the next 2 to 3 quarters. So in that sense, I think one needs to structurally wait for Tata Motors over a longer period of time. We have a structural call on Tata Motors. I think we like that stock. But long-term investors can basically look at declines on the stock from a structural point of view. On the two-wheeler side, again, I think it's typically the kind of discretionary demand and the kind of competition that one is looking at. So in that sense itself, I think we are bullish on Hero MotoCorp and Bajaj Auto from a long-term perspective. But then again, I think investors should buy these stocks on declines. You'll get better price entry points over the next 2 to 3 months. And then once, again, I think one should hold a structural view, assuming that discretionary demand comes back. I think they're able to maintain their margins and basically, I think, sustain growth over the next 2 to 3 years.
Right. Mayuresh, a couple of individual stocks, for the first quarter, we have witnessed, declaring very solid set of operational earnings. I'm talking about stocks like Bharat Forge, Escorts, even Amara Raja Batteries was good. These are mid-cap stocks but have managed to perform very well in the first quarter despite challenging environment. Any of these you like based on fundamentals?
I think yes. I think Escorts is something that we are carrying an in-house view of a buy. I think the tractor business has done extremely well for them. I think the management commentary has remained very bullish. I think if you go with the trends for M&M or Escorts over the past few quarters, I think you might see good amount of tractor growth actually happening, which will emanate into good volume growth for these companies. So Escorts looks good. So I think if the stock declines, I think that looks like a good accumulation from a long-term perspective. Apart from that, I think within the battery space itself, I think Amara Raja did post a good set of numbers. So I think Exide, which is a market leader in that segment itself, I think from a valuation perspective and being a market leader and considering that the replacement market of around 14 million units is much higher than the OEM demand of almost 1.4 or 1.6 million units, augurs well for these stocks. So yes, I think Exide from a valuation perspective on declines looks like a promising bet within the two-wheeler space.